everybody. Thank you very much for your time coming along to see us. So my name is Stephen Cooklin, Chief Executive of Manolete Partners. So to set the scene, as I'm sure many of you know, we undertook an IPO on the AIM market in December 2018. That went to a market capitalisation of 76 million. At the time of writing, we're up to 165 million, so more than doubled the share price in 3 or 4 months. You'll probably remember that the markets in Q4 of 2018 were the worst since the crash in 2008. A number of IPOs got pulled, you had Funding Circle and all the rest of it. So we were delighted to get the IPO away with such high quality shareholders. So Soros Fund Management came in for 11% of the raise, Miton, Gervais's vehicle, Hargreave Hale 9%, and many other kind of blue chip shareholders. And the IPO was heavily oversubscribed. You had orders for 45 million on a 30 million pound raise, which in those market conditions we were very, very proud of. And that really is a reflection of the quality of the company. As you can see there, revenues increased strongly last year, 121%, EBIT up 105%. The EBIT margin, which was announced for the 6 months to September 18, 51% EBIT margin. And then, whereas for the first half we had reported a 57% increase in EBIT, we put a trading update out in February, just last month, to guide the market up to an increase of EBIT of 70%, 70%, for this financial year, which ends in March 2019. So we're just literally 2 weeks away from that. So it's been what we saw last year has clearly continued, and the universe is expanding in the world of Manolete at an increasing rate. So what are we? We are the UK's leading insolvency litigation finance company. So unlike many of you might know about Burford and others, they are very broad funders of litigation. We specialise in insolvency and very much UK insolvency. And when I say we're a niche specialist firm, I mean that niche is a very, very big niche. There's at least £1 billion of insolvency litigation claims in the UK. We'll drill into that in a little bit more. And the reason why we like insolvency is it's the one area in the law where you can buy the claim. You're not buying the debt, you're buying the right to sue someone. And that gives us control of the claim. All normal funders are funding someone else's litigation. They are, the other party, the claimant, is making all the decisions. With Manolete, we've bought it, we're making the decisions, and that's increasingly important, as you will see. The case values range from just £20,000, but all the way through to £65 million. The average headline claim currently is £2.5 million. You'll see in a moment how strongly the size of the claims has been increasing. And as I say, 90% of our cases are bought. If you roll Manolete on a few years' time, because of various changes in legislation, that'll be very close to 100% by then. So this makes us very, very different to litigation funders like Burford, like LCM, Therium, Harbour, etc. So in February 2019, by that stage, we'd invested in 275 single case investments, which made Manolete the largest single case investor in the world. Australian business called IMF Bentham started 10 years before us. We've now surpassed that. To be honest, I could have got up here and just left the table here up for 20 minutes and you could have digested the table, because I think it really says it all. These are the returns on our investments. And probably the column on the right-hand side, as you look at it, is probably the crucial rate for any investment that anyone makes, is the internal rate of return. And as you will see there, for 7 years straight, Manolete Partners has reported over 200% internal rate of return every single year. The last 2 years have been well over 1,000 and indeed 2,000%. I mean, it is It's unheard of. I mean, venture capital, private equity in its heyday, a good return was 30%. I think another crucial factor is the completion of the vintages. You look at other litigation funders, there'll be cases still running from 2010, 2011, 2012. All our vintages up to 2015 have been completed, cash in the bank. 2016 has now been completed this current financial year. So we're turning these cases over very, very fast. We're completing fast. Why? Because we're in control. So the average duration, as you see there, is less than 12 months. And those of you with a good handle on maths, the minute you're getting a return on your investment under 12 months, the IRR becomes quite stratospheric pretty quickly. But the ROIs are very high as well. They're about 212, 215%, which, of course, the duration with high ROIs leads to very high IRRs. We've been recognised both within our own industry, the insolvency industry, as the preeminent litigation funder. So the industry votes every year. So in 2016, 2017. I think maybe more importantly, in 2018, 2019, Manolete Partners featured in both years in the Financial Times highest growth companies in Europe, top 1,000 highest growth companies in Europe. And this year we were the 55th highest growth company in Europe. And there are 26 million active companies in Europe. So we were delighted with that. The team, very important. I won't go through all of these. Just very briefly on my background. I'm a chartered accountant qualified with what's now PwC back in 1991. Spent 20 years in investment banking and then started working on this business back in 2009. Mina Halton has been in the company for 5 years. The second longest stayer in the company. She's a qualified solicitor in her late 50s. She's been doing insolvency litigation her entire career, and she's in charge of a team of 9 other full-time insolvency litigation professionals within the company, our in-house legal team, if you like. The other gentleman I'd like to highlight is Dr. Stephen Baister, bottom right-hand corner as you're looking at it. Stephen joined us as an advisor back in 2017. He stepped up to the board as a non-executive director for the IPO. For the 15 years before he joined Manolete Partners, Stephen was the most senior insolvency judge in the UK. And to have that level of credibility in our market is second to none. So why insolvency? And why UK insolvency? Well, it is a natural fit. When a liquidator or administrator or a trustee in bankruptcy is appointed, when a company goes bust, there are no assets left in the company, very few assets typically. So if there are claims to go after, clearly they need some funding from somewhere. So there are, in fact, the insolvency service statistics were just out a couple of weeks ago. So 16,000 companies went bust in the UK last year. And I would say that there would be a potential claim in every single one of those companies. So 16,000, at least one. Manolete at the moment, with supporting the numbers you've seen, we're running at about 90 cases a year. So there's a huge amount still to go for. There are 40,000 bankruptcies. What we do also equally applies to personal bankruptcies. And what happens in insolvency is, since 1986, a licensed and regulated insolvency practitioner is appointed to recover under the law as much money for creditors as he or she possibly can. So on the one hand, you've got a statutory duty to get in as much money for the creditors, but if the way of getting that money in, you need to litigate, often against the former directors, but there's no money in the estate, which is why having third-party litigation funding is a perfect fit. There's an outline of the cases in the pie chart there of the 7 typical cases that we do. We call them the 7 deadly sins. I'll run through a few of them. Directors' loan accounts. It's a very normal thing. For us, this is where a director has run his lifestyle, her lifestyle through the company. The family kitchen's being paid for by the company. The Arsenal season tickets are being paid for by the company. In the good years, year-end comes, dividend paid out of profits, wipes out director's loan account. Accountants up and down the country are telling them this is a way to do it. You won't have to pay any tax, no national insurance contributions. When the company goes bust, there's usually a very big outstanding balance for all that personal expenditure. The director owes that money back to the company and the creditors of that company. The biggest creditor is usually HMRC. They won't have paid the taxes for the last 12 months. They would have taken the tax money off their staff and not paid it on to the taxman. So when we get a recovery, about half the money we recover is going to the creditors. That is HMRC, that's you and I, that's hospitals, that's schools. Professor Peter Walton did a very useful report, it's all available online, on how big the insolvency litigation fund, market is in the UK. He looked at the stats from 2014, those are the only ones available. I don't believe, can't prove it, but I don't believe much has changed. So he said there are 2,300 cases a year in the UK, and the headline value of those claims was £1 billion, up from 300 million in 2010. And at the time, before you'll see the big bang in a minute, 93% of those were done on a no-win, no-fee solicitor agreement, where they get no fee. If nothing comes out of it, they get double the fee if they get a recovery. And then they got an insurance policy with a premium of around 80 to 100%, just in case the liquidator were to lose the case. So pity the poor creditors, because before the Jackson reforms, if a director was found guilty of owing the company, let's say £200,000, he'd have to pay doubled up legal fees of another £100,000 for the CFA, and then an insurance premium probably of the same amount. So the Jackson reforms came along in insolvency in 2016, and they said that those legal fees, those insurance premiums have got to come out of the damages recovered. So what Jackson said was that the legal fees and insurance costs were about 200% the size of the damages. So if they've now got to come out of the damages, what's left for the IP's fees and what's left for the creditors? Absolutely nothing, which made a mockery of the Insolvency Act. So our solution delivers over 10 years, we've seen it year in, year out, the cost of running these claims is just 15% of the damages recovered. So it really is quite a revolution to the insolvency litigation market. So once we've recovered our costs, the way things typically work is we split with the estate, with HMRC, the creditors, etc. They get half, we get half, roughly speaking. On really big settlements, £1 million, £2 million, £10 million, our share will go down a bit to 40% on average. Theirs will go up to 60%. That's fine. So there's a little example there. A £500,000 settlement. This would be a classic Manolete type result. Legal fees of about £75,000, which meant that the net proceeds would be split 200 odd with the creditors, 200 odd for Manolete. That would deliver Manolete a money multiple of almost 4 times, a ROI of 280 odd %, and the average duration would be about 11 months. So fabulous returns, but also fabulous returns for the creditors as well. Big Bang Part 2. The reason why we've got a few funded cases still left, so 90% purchased, was that until 2015, we could only fund the Insolvency Act claims. We could buy the bus company claims, we could only fund the liquidated claims. That all changed in 2015. So any appointment of administrator after that date, we can buy all those claims as well. This is very, very different to normal solvent litigation. As I explained, the other funders are funding someone else's claim. If you're funding a divorcee, she's going to want every penny from her husband. She's going to want her day in court or 2 weeks in court, telling the world what a bad man he is. And rational judgment gets distorted. These funders are committed to funding these costs. They can't interfere with the decisions on the claim. They've just got to keep paying the fees. Compare that to Manolete Partners model, and it's the only area of the law where we can buy the claim ourselves, and we have no emotional attachment. The creditors just want their money back. The IP, the liquidator, wants his fees paid, so everyone is aligned perfectly. So for example, if we've got a £5 million claim that we've bought for a few £1,000s, and let's say after 10 months and we've spent maybe £100,000 on it, we get an offer for £2 million to settle, we can just take that settlement. Thank you very much indeed. Huge money multiple. If it was a funded case, we couldn't make that decision. If we don't like the look of the case, let's say we've bought the case, we get a letter back from the defendant, either saying they've gone bankrupt or they've got a good reason as to why they shouldn't be, why it's not a meritorious claim, we can just stop the claim there. Again, if we were funding a third party out of control, they would keep going. We just have to keep paying. We've built up a very strong network of insolvency practitioners across the UK, so 280 firms, many with multiple offices. You will know them: PwC, Begbie's, Grant Thornton, Moore Stephens, and these firms are sending us every single day cases for us to invest in. 60% of our claims that we've invested in are repeat business. And again, these other funding companies, they'll work once with a particular party. Because we're funding professionals or purchasing from professionals, IPs the whole time, you establish long-term repeat referral relationships. So the quality of our income is as high as it can be. 4 minutes left, so very briefly. This is the internal process we go through when we take on a claim. So as you can see, the quite important numbers at the bottom there. So £5 billion worth of claims since we started. We accept 18% of those. The first thing we do, we check, have they got any money? Could be the best, most meritorious, interesting, fantastic legal claim in the world. If the guy you're going after lives in a housing estate in Newcastle, stop work. It then goes, if it passes the net worth check, you then do the legal merits assessment, the 9 people, 9 lawyers in-house, and we've got the judge, of course, to tell us if we're getting it wrong. Then goes to the investment committee to structure it in the most optimal way, and then we're monitoring the investment every single Monday morning. The entire team is going through the 90 live cases one by one. Quite importantly, I mentioned size before, so the completed 188 cases generated 30 odd million pounds, 87 cases live when we did this slide, generating 37 million. So the average size per case have gone up from £166,000 to £434,000, and that trend is continuing, which really is supported by the KPIs here. Ever since those Jackson reforms that I mentioned, the big bang, the legal changes, as you can see, the volume of new case inquiries going up very strongly, and the value going, well, words can't really describe. It's going up very fast indeed. 2 minutes left, just to maybe touch on a couple of case studies. Bottom left-hand corner, huge amount of these cases at the moment. Tax avoidance cases, you probably seen an awful lot about this government thing about the loan charge in the papers at the moment. Well, the thing is, HMRC is big creditor on a lot of companies where they've used disguised remuneration schemes to rip millions and millions of pounds out of UK companies, leave HMRC high and dry. So we've bought a whole bunch of these claims. So this was one that we did. UK company, private company. Our costs on the claim were just 50,000. It was settled in just 7 months. The settlement was £2.2 million. Manolete's profit was 10 times, so £500,000. And you'll say, well, hold on, why on earth, if you go 50-50, why on earth did so much of the settlement go to the creditors? It's because we'd already made 10 times our money. We just wrote out a cheque there and then to HMRC for another £250,000. We don't need more than 10 times our money, thank you very much. That's fine. So the growth strategy, I'm into my questions, but I'll just finish if that's all right. As in the admission document, it's to expand our regional network. So it's working very well. We've now got full-time lawyers in Manchester, Bristol, Southampton, and Cambridge, covering different regions of the market. Scotland starts in May, and then we've got offers out in Yorkshire and the Midlands. And the idea being that we have local lawyers talking to local liquidators and local solicitors. And we road tested it in Manchester, summer last year, and within a few months, £40 million of claims, which we never would have seen, came flying through the door. So much more of that. We can take on more cases now thanks to the IPO proceeds. At the same time as the IPO, HSBC increased their revolving credit facility for us from 10 million to 20 million. So gearing up the business a bit. At the moment, we are completely debt-free. We have 10 million free cash on the balance sheet. And the interest rate on that debt for a litigation finance company is just 2.75% at a maximum. So HSBC obviously like the numbers they're seeing. Thank you very much indeed for listening. Delighted to take any questions.
Lovely. Stephen, thank you very much. A gentleman here, please, Peter. Hand up.
Thanks for the talk. The IRRs historically are really impressive. The obvious question is how sustainable are they going forward? Sure. Will competitors come and pile capital in?
Good question.
And will creditors like HMRC ask for a higher percentage?
Yeah, all excellent questions. So will the historic returns continue in the future? Absolutely. As the cases increase in size, the cost of the legal work pretty much the same. The amount we're paying up front is pretty much the same. So in fact, the IRRs should be increasing, the money multiple should be increasing. There's just a natural economy of scale when cases get bigger. It reminds me of my work when I was in corporate finance. It's the same kind of accounting and legal work you've got to do on a £100 million takeover to a £5 million takeover. So it's very effective. Competition, they've tried. It's very hard for the competitors to deal with our first mover advantage. 300 cases into it now. Everyone knows us. So someone said, I was talking the other day at R3 South, and the introduction from Registrar Briggs actually was, here's Manolete Partners about to speak to you. They are synonymous with insolvency litigation. We're just in the, it's been hard work, but we're in the fabric.
Gentleman here, please. Thank you.
Congratulations on a great start.
Thank you.
To public companies.
Hope you bought some shares.
I did actually, yes.
Good man.
Thank you. What do you think will be the first restriction to growth? Cash or capacity within the investment committee to review cases as the numbers grow?
I don't think it is the latter because, as I said, there's 7 typical cases. They just go round and round and round again. So we decide on cases. Our internal in-house team, the reports they give the investment committee, usually within a week. Other funders and even ATE providers take 3 or 4 months. It's because it's the same repeat 7 deadly sins. So that means our decision-making at investment committee level can also be equally the same. Tick the boxes. It's all pretty mechanised now internally. So that doesn't concern me. The concern has been, and will continue to be, is the lawyers. Taking lawyers from a situation where they're advising liquidators and administrators on all the risks they're taking from undertaking litigation. They've got to change their mindset at Manolete to look for what's the angle to close this nice and fast. And those are quite rare beings. And if anyone were to try and build a team like that, it would take ages because there's an awful lot of the former and very few of the latter.
Another question just, across here.
Yeah, I think you kind of touched upon it slightly, but how big is this market, do you think, and what percentage do you currently have?
Great
and
question.
What percentage are you aiming to have?
Excellent. I was glad someone asked me this. Thank you. So I mentioned there's £1 billion a year of these claims that have historically been done on the old CFA ATE basis. Now, half of those are complete rubbish. Okay, so we're not interested in it. So that pulls you down to £500 million of claims. That's our addressable market. Now, at the moment, our market share of that is maybe 7%. Our mission at Manolete over the next 3-4 years is to grow that to at least 30%. That would give us total recoveries of about £150 million. Take off 15% for the costs, as I mentioned, give you a revenue for us, a gross revenue for us, of about £120 million. Let's say our share on a weighted basis is 40%. Let's say this gentleman's question, we've got to give HMRC a few more points. So that would take us to a gross profit of £50 million. Overheads currently running at £3 million. My CFO thinks at that state in 3-4 years' time, probably £7 million. Let's call it 10 for easy numbers. So that's 50 gross profit minus 10 gives you £40 million EBITDA. Tax it, put a multiple of at least 55 on it. That's a joke. It's a finance joke, everyone. Yeah. But great question. Thank you.
Gentleman here, please.
2 questions. Number 1, what is your success rate of the cases that you'll take over?
We've lost one.
Lost one out of?
270.
Okay. The second question is, what is your corporate ownership? Who owns the shares?
Sure. So John Moulton, the venture capital guru in the UK, he backed me in 2012. He invested 5 times up to the float. Peel Hunt practically had to break his arm to sell any shares on the IPO. So he currently owns 26%. I own 18%. You've then got Mike Faulkner, who is the CEO of River and Mercantile Group. He helped seed the business in the early years, very smart cookie. He owns 12% of the company. And you've then got the shareholders I started with, Soros 11%, Maiton 10%, Canaccord 9%. So when you add all those up, it takes you to about 90-odd%. Long-term, either inside or strategic shareholders of the business. Thank you.
Stephen, were you underpriced at IPO?
I think the share price says we were. I mean, it's more than doubled in 3 months. I can't remember many since the dot-com eras that have done that. So, yeah. Well, the case against Peel Hunt will be case number 200.
Lady at the back, please.
Hello. Do you pay dividends? And
We do.
You do.
We do. Yeah, 20% of post-tax profits, which I think is the highest of all listed litigation funders by a long way.
Okay, thank you.
Thank you.